And I have to say, I saw Target's results. I know expectations obviously were relatively low based on what Target told us last quarter about lower discretionary spending. But then you have a retailer like TJX, very discretionary in what it sells, largely clothing and home goods. They had really good results. So what's going on here? Is this a Target issue?
Look, I mean, I think TJX may have been a little bit more of a one-off. Obviously, extraordinary results. It's one of our top picks right now. But I think as it relates to discretionary, I think we're still in a very mixed environment. I think discretionary trends are still somewhat difficult. Although even at Target, they did on the margin sound a little bit more constructive. They talked about seeing some green shoots in the consumer and feeling a little bit better. They talked about the traffic trends improving from June to July. So, again, second quarter, I think when all said and done, will prove to be a tough one for discretionary, but it's certainly not getting incrementally worse, which I think is pretty positive.
So, Ed, I understand what you're saying about some of those green shoots that Target referred to, and they certainly said that July improved over June. If that's the case, though, and they beat profit handily by 41 cents over the street, why take your profit forecast down by $1 for the remaining 2 quarters and lower that sales guidance?
Hey, we're just trying to be conservative, right? I think obviously in this environment, companies continue to struggle against the consumer. We just wanted to make sure we were positioned correctly from an earnings estimate perspective. We actually lowered our estimates earlier this week based on some of the data we were seeing in terms of traffic. But I think the bigger picture is less about what we see for the balance of this year, but is more around the longer term opportunity in 24 and 25. And I think what we heard from Target today, while still very early, gives us confidence that they can regain some of the margins that they've lost for the past couple quarters.
We had a guest on in the last hour who gave his diagnosis of what has ailed Target, not just over the past 6 months or year, but over the past 3 years. If I asked you that question, what would you say has been the problem there?
I mean, I think some of it's been mixed, right? I think, we've been in this environment that's been very focused on food and must-have items, right? And this has been really since inflation started. So I think that certainly ailed Target, given that they just have a lower food mix than some of their other peers. I think some of it is some of their peers are taking out of Target's playbook, right? Target has been known for great and differentiated merchandise, private label, and you're seeing everyone across the complex, right, getting better at private label, getting better at apparel. And so I think that's all probably hurt Target to some extent or another. And I think the bigger, kind of overarching reason that we continue to watch is, you see at Walmart that candidly is getting better at that more upscale consumer, that over 100,000 consumer. That's directly in Target's wheelhouse. So there's certainly a little bit more head-to-head competition, I think, than we've seen in a long time.
So the competition is, the other guest pointed to inventory issues that seem still, in his point of view, to be bedeviling them. Do you see that?
I mean, their inventory numbers were actually pretty clean. They were down 17% year over year. On the call, management was very constructive about inventory. We did checks. We've done checks even this past weekend and feel pretty good about where they are in a position for the balance of the year. So I actually think inventory is less of an issue. Mm-hmm. And in fact, I think the gross margin results you saw today really pointed to that, right? They missed on top line, yet grosses were up over 550 basis points. That doesn't seem like an inventory issue to us.